Welcome back to the channel. I hope you're doing well and you've got a nice cup of coffee for this Sunday morning. Today I'm going to be talking about how high interest rates will go. And I've got a This Is Money article today titled How High Will Interest Rates Go? Bank of England in Quandary as it hikes to 4%, but inflation is forecast to drop swiftly to 3% by 2024. The Bank of England said the recession expected to be shallower than forecast. The UK's central bank now left with quandary about what to do as inflation eases. So the Bank of England raised interest rates again today, even as it forecast inflation would drop to 3% by the start of next year. The Monetary Policy Committee voted 7-2 in favour of adding a 0.5% base rate increase from 3.5% to 4%. Now this is the highest level for 14 years as it battles to stem roaring prices. But the tone of the bank's monetary policy update was different to the recent ones, and it said that it thinks inflation should fall quickly, adding that the UK's recession is set to be much shallower than previously expected. Now, this is quite interesting here, and it's notably about likely energy. Energy takes up a large point of our inflation increase in the UK here. And actually, we've seen electricity prices in the United Kingdom certainly fall over time. You can see here that as we're looking at the February 2nd, you can see this massive decline from earlier in the year. However, it's important to note here that energy prices in households are likely going to stay high until these energy suppliers can shift their inventory. So for now, as for consumers, things aren't that promising yet, but it will certainly help obviously ease into the cost of living crisis, which isn't a good thing, but it does mean that spending will be muted potentially here as obviously households continue to spend on high energy bills. But as these come down, hopefully at that point inflation has already started to ease and we're at a good stage. So what has happened today? This was led by the Governor of the Bank of England, Andrew Bailey, who was in the thumbnail of this video. And basically, as I said before, two were against this 10th consecutive rate hike, or the greatest amount in the last 14 years. And this gives a more dovish signal, which basically says, well, maybe inflation is going to fall in the short term. Perhaps now there isn't as strong of a push. And it might question the matter. They've increased obviously from 0.1% here since December 2021 to 4%. How much higher is this going to go? We've seen UK inflation figures, and they seem almost quite muted now. Whilst yes, it certainly is high still, we're at 10.5% as of December 2022. This was a decrease from the period before. So a lot really depends on what will change in the next month. Will we see inflation continue to fall like the Bank of England anticipates, in which point we're probably at a good position? How much more should then the Bank of England increase prices? Not increase prices, but increase rates. And again, it should be of a point here, because will interest rates be cut quite quickly after this? Will inflation fall so low that actually they struggle to get a handle on it and we may see deflationary territory here? Now, there's more in this article here. Their goal, obviously highlighted here, is to return to the 2% target. And obviously the month now, they've gone to 4%. Now, I've highlighted a few things here. As 2023 turns into 2024, it sees inflation at 3%. And that's their forecast. The market consensus forecast for the base rate is to peak at 4.5% this year. There's a decent enough table here that shows the bank's percentage rate. Lately, you could see that before the financial crisis, it certainly was up to nearly 6%, and a majority of that was cut away in the midst of the financial crisis. And you can see that really since the EU referendum and obviously the pandemic, it was at the lowest ever to now see this great large increase. And they've even said that the bank could cut interest rates from their peak as early as the end of this year. Now, that's an interesting point here, because we're obviously seeing these interest rates increase. We're seeing mortgage rates go up. We're seeing the likes of savings accounts, which have now seemed to have peaked, but they're at very high interest rates. So it would be a good time for an investor to perhaps look towards a fix if they've got a savings product with a high enough interest rate. And you can see the inflation, annual inflation change here, and you can see how greatly above it is. And in fact, I've got a graph here that goes back to 1988, and you can see here that the base was set in 2015. I've got to scroll even further here, And in that time, we've gone up 27%. So since 2015, inflation, or the cost of goods, has gone up by 27%. And you can see the annual rate in this graph here, which I'll just need to adjust, how it is now pretty much higher than the record show here, which is from 1989. We've seen a very, very high inflation figure, and this obviously could be a concern. Now, they've mentioned here in the monetary policy report, it said that global consumer price inflation remains high, although it is likely to have peaked across many advanced economies, including the United Kingdom. And that really gives us a thought. How high do we think interest rates will go? How do we think this will impact our investments? And is it a time to buy, or is it potentially too late? So I'm going to discuss my thoughts. In my opinion, interest rates rely primarily, especially when they're set by the central bank, on historical data. So they're looking back and they're going, how has spending been over the last 12 months? And this is a very logical approach. However, it's hard to look forward when you're obviously staring at your rearview mirror looking behind you. So whilst there may be indications via futures or via forecasts that inflation is going to drop, they've very much got to follow that rear view mirror approach. And obviously that is the less risky method, but more likely to be incorrect over a, let's say, shorter term period. Now, that said, I think really if I'm going to guess what the interest rates are, it's only going to be a guess. It's not going to be a prediction. It's not going to be a forecast. It's going to be speculation. And it's probably not worth anyone's time or how I could even get this. And realistically, if I had to bet, if I had to gamble, I'd say realistically interest rates will probably peak at most at 5.5%. And even I think that's quite a high figure. I don't really think they're going to be pushing much higher than this unless inflation sustains or increases and goes up once more. However, as mentioned earlier, with energy prices shifting downwards, I don't think that's very likely, and I do think that the worst is behind us, and the stock market agrees with that, hence why we've had such strong year-to-date gains. So how will this impact our investments in the stock market? I mean, at the moment, we've got this optimism over falling inflation, right? And the stock market is looking months ahead into the future and going, you know what? This looks okay. So we're seeing stocks rally. We're seeing quite a strong recovery at the moment. And at this point, it might be of concern for those that are, let's say, risk averse. Perhaps these investors are going, well, hang on, I've seen some massive stocks rally 10, 20% year to date. This is a concern for me. Is this a lot of greed? Is there a high level of greed in the markets? And is it really a wise idea to be buying now? What has fundamentally changed with these companies or the investments? Okay, well, the outlook for the economy is now a more positive level, but it's important to remember here that the stock market is not the economy, so it's not really going to relate there. Whilst there can be some correlation over time, it's not the same. And realistically, whilst the markets have been very optimistic at the moment over the idea of inflation peaking, it certainly could get worse regarding the economy in the shorter term future. I mean, we've got these predictions here by the IMF suggesting, let me just scroll over here, that the 2023 GDP prediction, the UK is the lowest amongst the G7 nations. You can see Japan at 1.8%, the US at 1.4%, but the UK is set to decline 0.6%. So that's not obviously promising for investors in the UK, and it could certainly get worse. But why have these stocks then increasingly rallied forward? And as I say before, it's important to remember the economy and the stock market are not the same, and they're not going to always correlate at times. So at the moment, there's a lot of hype in the markets, there's a lot of greed, investments are pushing up. I would encourage more than ever to do more due diligence, to really focus on your valuations. Tougher times may be approaching, so now might be a good time to be more of a value-orientated investor, where you're looking at stocks that have maybe more attractive price-to-earnings ratios and going, okay, what is the market average? What is this current price to earnings? Okay, if this mean reverses, and let's say a price to earnings ratio of 6 could maybe meet the market average of, let's say, just 12, then there's good potential there. And I think really with these high year-to-date gains, whether it's time to buy or not, as an individual stock picker, I think it's a very tricky question to ask. I think if you own broad-based index funds, then it's a very simple question. Just continue to dollar cost average into the markets, buy as frequently as you get paid, and move that money out of your account when you get paid are the first thing so you don't even notice it going. That is a great way to achieve long-term wealth with the historical annual average returns of the S&P 500, which is 8% per year on average over a 30-year period. Now that's a great strategy. Just keep buying. It doesn't matter if the stocks are up this month or down next month, because ultimately you're continuing to buy, accumulate, and build up a war chest of investments. But it would be foolish to try and approach or use that same approach in index funds in individual stock picking. And this is something that I perhaps neglected in the past. I just assumed that foolishly I could just dollar cost average into my investments. And realistically, more valuation needs to be considered. Some of my stocks have rallied greatly. You can see my portfolio here. We've got the likes of Boohoo at 50 pence a share. Now that's quite a rally from where it was a few months ago. That said, you scroll back a year and it's down significantly still, and you can see that my overall position is down 58%, but it is food for thought. And I think realistically, in my position with Boohoo, I was overexposed to it. I kept buying as it was falling, and that led to a really ridiculously overexposed position, when in reality, what I should have gone is gone, okay, look, I like this company. I think the fundamentals have slipped slightly, but I still believe it's a long-term winner. Therefore, I'm going to continue holding and only buy when this company looks more positive, when the fundamentals are back to growth. Sure, I'll miss out on buying the bottom, and at the moment I certainly have, but at least then I can buy into a quality company and not risk too much capital. Now, this is really easy in hindsight, but at the same time, I think a more disciplined approach could be worthwhile, especially in the year of 2023. I'm holding a little bit of cash at the moment, and I'm really wanting to be buying some United States stocks, such as your Google, or your Alphabet, your Amazon, some big companies that would give me some great diversification, but I can't quite justify the price at the moment. Perhaps I personally got too greedy in that I wanted Google's share price to drop below $80 to $75 a share, and at which point I would have felt that was a good valuation. But for now, I'm stuck with the UK markets, and I'm purchasing more shares of the London Stock Exchange Group. Now, even this stock is pushing up slightly, so it is one to keep in mind, but I do think it's going to be a more defensive position that's going to hold about 10 to 15% max of the portfolio and give it some resilience overall. But going long term, as I say, I'm going to keep buying, and I'm going to keep putting monthly deposits into the portfolio and buy where I see value. I'm not going to worry about what the economy overall is doing, but I'm going to encourage good investments, buying businesses with strong moats, meaning that if they obviously have competition, that they're easily able to fend it off. I'm already exposed to the likes of Boohoo, or let's say a more riskier investment, and so I'm not in any rush to buy more. And ultimately, if this means I miss out on the bottom and I miss out some of the gains, okay, great. But at the end of the day, at least if it drops further, I've got an opportunity to reevaluate this, and by then maybe I'll have a larger cash position and therefore an ability to take action where it matters most. Thank you for watching. If you like this video, definitely drop one of these. Have a fantastic day.